Okay, because we are recording, so maybe I won't be able to interact too much with all of you. We'll still have a lab session, although it will still be online. But I think you guys can bring up different questions during the lab session. So we are at the last part of the inflation chapter. Again, inflation is something that happens naturally in the economy. There could be inflation, there could be deflation, but it will influence the purchasing power of the money that we receive uh, at different time. So we need to convert them into the value representing um, the true the same purchasing power, uh, and then we need to, if we want to understand the convert the money to equivalent words, then we need to consider their interest rate, that is the considering their purchasing power. So again, originally we only consider earning power. Now we need to also consider the purchasing power and adjust them as we need. And previously we saw some relatively straightforward conversion. Those conversion were uh, for inflation deflation uh, will be um, almost identical to those conversion for adjusting for the earning power. And we can combine these two together to get the market interest rate, and we can, so that we can convert directly from market from actual dollars to their equivalent words. Then we can go through the same decision rule for determining whether or not we want to accept or reject a project or an opportunity. And there are some just qualitative description on the effects of inflation on project cash flow. Okay, so we see the project cash flow, and we see these different values, and these are different values. Uh, uh, in fact, will be influenced. The actual value will be influenced by the change of the purchasing power at the time. Um, so again, you can go through them and think about it a little bit. I won't go explain them individually, but for example, here they have this depreciation. We have depreciation expenses, right? However, the depreciation expenses in the future is it become a very smaller value, because if you consider on the inflation, so the in the future the expenses will be a lot higher, but we can only use the old uh, numbers on the book for depreciation, treating depreciation as expenses. So which means that we are in some sense paying higher taxes. You can imagine that, right? Because and also salvage value, loan repayment, working capital requirement, and so on. Not even rate of return or net present value. Uh, they are, if we just take the number that we see, then the inflation will create all kind of impact. Here, as you can see, that with the inflation, in fact, our low our rate of return or our net present value will in fact be smaller, right? in fact be smaller because the dollar amount that we see will be, which is the amount that we see and have do not have the kind of purchasing power on the dollar, and we need to take out that inflation rate. Then we take out the earning power part, and altogether, so the return of the rate of return, which will be the amount taken of the from the inflation being taken out. So it will be a smaller value, which we have already shown previously. Well, so you can sort of read through them. You can think about it, but basically it follows just very simple logic. That is, we have in the future, usually we have inflation. Given that we have inflation, then a lot of the cash flows during our analysis do not reflect the true value of those amount, those number that you see do not reflect the true value because of influence of inflation. Okay, you can go through them. I think they can be understood relatively easily. Okay, next. Okay. So here, here is just an example. Again, after-tax cash flow. When we are considering tax, the amount of money that we use to calculate will have to be actual dollars, right? Because for the tax purpose, the taxing office or in the U.S. Internal Revenue Service will see the amount that is shown on your income statement. So that those are what actually happen. So those will be hello?
Hello, sorry.
Okay. Yeah, for the extra dollar. So if we do extra dollar, we have revenue. Yeah, let's just say expense is 8% of the there's inflation rate of 8%. So the operation and maintenance costs will be this amount, 8% increase every year. And the depreciation will not change. Depreciation are allocated. They are allocated previously, right? And then we can compute our taxable income. Okay, but operating costs will be increased, but revenue may still stay the same. Okay, and we can compute taxable income. Then we'll get our income tax. So the net income, which is taxable income minus income tax over this, is similar to what we computed earlier on, except that our variable cost, or not necessarily variable cost, operating and maintenance cost will have 8% inflation. Okay, so this will influence our computation. Next. So again, if we want to come up with net cash flow, we in net cash flow statement, previously we had the income statement. Here we have net cash flow. In income statement, we have computed net income, or this net income, and we need to add depreciation back because depreciation we did not pay. Then these are the other factors that we have, and just put them on as we had previously in the example. So we can compute net cash flow in actual dollars. As I said, since we are computing tax, we'll use actual dollar so that we can compute tax. So we get these net cash flow. So this net cash flow, and we know how we can change the net cash flow to the constant dollar, actual dollar to constant dollar, right? So inflation was 8%. So I'm not sure here they're using 8%, but anyway, inflation could be 5% on this page. Okay, so we'll take 5% out. Okay, and this value we need to consider the interest rate. So they need to be discounted to the present worth because we are finding equivalent present worth. And we add them together to get net present worth, which is 587. It's different from what we had if we don't have inflation. Okay, so the cash flow here seems to be a lot bigger. If we take this and there's no inflation, then we can get a much higher equivalent present worth. However, once we take out the inflation, so the values that we saw on actual values become smaller. These are in constant dollars with the same purchasing power. Then we want to discount them to the present time, right? Because we want to discount their earning power. So take them, so we get these so-called equivalent present worth. Then we add them together. It's only 587. It's barely making any money, but based on our MARR. Okay, but we'll still accept it because MAR has already guaranteed that percentage of return, and we have 587 more than what MAR is required. So we'll accept this project. Okay. Yeah, hopefully you can understand. This is just the same as what we had before. Only different is now we are because of tax reason, we are the data that we have are considered as actual dollars. Since they are actual dollars, we need to convert them to constant dollar, then find the equivalent present worth. Of course, as we said earlier, we can compute the so-called market interest rate or inflation adjusted interest rate. Then we can then we can convert directly from net cash flow to equivalent present worth. Okay, that we can do too. But anyway, they here in this table they show the process of discounting in 2 steps so that you understand. You can see the numbers and understand the impact of having inflation in the cash flow. Okay, so next. And we can also compute the so-called rate of return. So as I said earlier, the rate of return, the true rate of return for the problem under inflation will be smaller, right? The true will be smaller. That is, the rate of return we want to compute should be based on constant dollars rather than actual dollars. We saw all the dollars, but those dollars were inflated due to inflation. For example, if we have net cash flow in actual dollars, right? These are the amount that we see. And if we compute them, we found out that their internal rate of return is more than 30%, 31.34%. Okay, it's not the true internal rate of return because these numbers are in actual dollars. They are not in constant dollars. So what we need to do is take out the influence of inflation. So with 31.34%, and we can divide it by this. This is the inflation rate. Okay? Inflation rate is 10%. We can divide them and -1 to help us to get this interest rate. This interest rate is taking out the influence of the inflation, so that we get only 19.4%, which is so-called inflation-free interest rate. Inflation-free interest rate. That is the interest rate characterizing the earning power. So the rate of return for this project is 19.4% rather than 31.34. 91.4% represent the earning power of the cash flow. The earning power is referring to the constant dollars, like the return in the future. If it's 19%, that 19% of annual return gives you the amount of the increase, the amount of money increased in constant dollar. Okay. So that all the monies are in constant dollar. All the money that you see in the constant dollar analysis will give you money of the same purchasing power. And here is actual dollars. They do not reflect the same purchasing power. Different years will have different purchasing power. So it is just the appearance that you can see. However, the true earning power, which should be based on constant dollar, will only be a little bit less than 20% rather than something above 30%. Okay, so this should be the last point that I want to address, and which we have already discussed previously, because the 31.34 is so-called market interest rate. Oh, you can see that. But if you understand that recently the inflation rate is very high, right? If you know that we are facing a high inflation situation, then you may need to consider seriously taking out the inflation factor out of the market interest rate to get the return based on constant dollar, that is based on the monetary amount, the amount of the same purchasing power, so that you have a more consistent way of looking at the dollar amount you have over the years. Okay. Okay, next page. So that part up until then, we have been looking at inflation. It's not difficult. I think the only part could be a little bit confusing is the terminologies. Once you get familiar with those terminologies, you associate them properly or compare them properly with the earlier part of interest rate and so on, since the mechanism for converting them are the same, and so you should be able to deal with such kind of problems accordingly. The next part will be on project risk, and and uncertainty, meaning that things could be even more complicated. That is, we don't deal with deterministic number. Like in the future, we cannot really say that it's one way or another. For example, I can say, oh yeah, tomorrow, next year, oh, I think the market demand will be at certain number, but for sure you will not be that number. Like you can probably guess, and I can also predict that, oh, the unit price or the unit cost, the labor cost, all these different things, or the fixed cost if you want to buy a machine at a certain time, but it's not right now, then and you can estimate the cost or predict the cost, but those costs may not be fixed. So these uncertainty brings risks into the project, and these uncertainty can also risk can often be modeled and deal with probability. I have to say that probability is not something, at least for, I think for most of the people, probability is not something that intuitive. Some may be quite good in probability, but I think a lot of people, most of the people may not be good in probability. Probability, the reason that I say that is not very natural is if we deal with, for example, numbers, I think it's almost based on humans' biological characteristics that we develop those numbering system and computation and so on. Number we seem to be able to relate because physically we can use our fingers or some other discrete elements to reflect numbers. If we think of geometry like in the space that we have, we look at these lines, these circles, right? These different shapes. We seem to have the sense of geometry too, but probability seem to be something created, right? These kind of feeling and the exact number and usage, the ability to use them, I feel that is an acquired ability. It's not that you are born with. And probability has been developed just, I think, well developed so that it can be used in more places, maybe just within a few, probably couple hundred years, which I'm not sure, but basically it's not being used that much in the past. In the past, everything will be more deterministic. That it's a certain number rather than it could be this, it could be that, and how do we describe them? Okay, and of course now there are a lot of people studying probability. There was also a very interesting story about a very famous mathematician. He never trusts experiments. Everything need to be proven mathematically, right, analytically. But when he dealt with probability and people told him the solution, and he just could not believe the statement to the extent that he conducted extensive simulation, which is experiments, until the result showed that was exactly the case. Then he accepted the fact. Right? It's world-renowned mathematician and could not understand simple probability. So just so that you know that it could be for some people not as easy to capture the essence, but it's okay. We'll just use the we won't use it for complicated cases. We'll just use it for more basic cases. So next. So here again, the risk means that potential for loss, right? Yeah, we don't want to perform our analysis. In the end, we say, it's going to make a fortune. Oh yeah, it's going to break even, and in the end, we lose money. And that's for business. It's really a very bad situation. A risk is usually means that the potential for loss, and there's something that is true in general. That is the greater profit that you may get, the higher risk it is. There are probably very few things which have very low risk and very high return. That's almost the reality. And people taking higher risk, they could lose everything. But if they succeeded, they will succeed in a greater scale. People not willing to take risk, their lives will be a lot more smoother, like no ups and downs. It doesn't fluctuate too much. It's every day is very similar. But chances are this kind of life will not bring any significant progress or opportunity. Okay, so having risk is not necessarily bad. Higher risk usually present, well, it should be the other way around. Higher profit is usually associated with higher risk. Right? It's not that having risk is always bad. So if the risks is associated with higher profit, then you may also consider that. But this is something, again, you need to think more logically. A lot of people may get wrong feeling with the risk because or the opportunity, because they always think that I still have this opportunity, but they never really assess the risk or the probability or the opportunity. Okay, and there are different kinds of way to assess the project risk. Usually we'll, for example, here you can see if we are trying to see if we want to accept a project, and the way we do it is we compute the net present worth, but we don't have a fixed present worth. So what we may do is we'll compute an expected net present worth, and we also want to look at the of the. If it's too big, then it could mean that it's quite dangerous, and then we won't do it. But if it's not, then we may still try. Okay, next. So this is a very simple example, and I think a lot of people knows it. This is like lottery, and lots of government do this. A casino does this too. Government do this because some government, for example, in Taiwan, government allow banks to host this kind of lottery, but the amount of money that received or earned by the bank, the organization running the lottery, will pay very high tax to the government. So the government has money to do different construction. I'm not sure if it's right or wrong, but a lot of governments are are doing that. I think Hong Kong, Macau profit significantly from casinos, and of course a lot of money will be taxed by the government, so that the government can easily accumulate a lot of financial resources. If their monies are in good use, it does a lot of good to the society. However, we don't want people to lose all their money, their family, everything in a casino. So there should still be a balance. People go into casino always feel that they may win. And when they see the price, for example, here, there's this price. There's out of 44 numbers they draw. If you can match all 6 numbers, you get 27 million US dollars. Amazing. That's why, right? If out of the 6 number, they are identical to the one you have, then you get a lot of money. And the second prize will be you match certain number, and there are 228 possibility. And the third and fourth, right? And the fourth, you only get $1. It could be 168, more than 168 prices, each get 1. Right? So people always feel that I have the opportunity to win this 27 million. And I think I used to have classmates. He bought lottery, and I was alerting him that the odds was very low, and he was saying that, do you think that you have any opportunity to earn this amount in your lifetime? I said no. Then he said that I have, although the odds was very low, but he feel that he may have this opportunity, but in fact it's quite low. But how low it is, and what it will be with that kind of odds and with this kind of amount, what will be the expected profit? In fact, I did some computation. They are all similar. They are all similar. The expected profit that you'll get, expected return that you'll get, is in single-digit dollars. Right? It's not the expected value. Is not, oh, there's a risk. Maybe my chance of getting it is 1 in a million. In fact, this is a lot more complicated than this. Next. So they did this computation. So you have 44 number. If you get all 6 of them, what's the possibility, right? There are many combination. Then what will be the odds? Then 1 divided by these many combination. So this is your opportunity. If you compute multiply this by the price and multiply this by the price and so on, you'll see that your odds, your expected returns are not big. That you need to know. You cannot just see the value. You have to see the odds, the opportunity, the probability that you'll actually match the 6 numbers that they had. That probability is very, very low. Okay, so again, you cannot just look at, oh, this project, wow, the return is very high. But what are the risks? You have to know how likely you will get that amount. You have to know. You have to assess the expected value and use some understand the variability of the outcome that you may get. Okay, that again you have to know. So So there's a project, and this project return is very high, or there's a technology that you may want to adapt for your new products. But if there is a risk in that product, you have to assess the risk so that you can understand how likely you can achieve the goal and whether or not the variability is acceptable. The variability can be characterized in different ways, but basically you need to understand that rather than just looking at the numbers and imagining that this is my opportunity, but how possible this opportunity is still uncertain. Okay, next. Yeah, there are different methods for describing the so-called project risks. Okay, here these are something that people use. We will not go through a very detailed analysis, but I will tell you basically how they are done. Because in the examples there are numbers, but these numbers I don't think we have time to go through the derivation. But I think going through the explanation, you should be able to have some feeling of how these tools are used. The first tool is about sensitivity analysis. It's very simple, right? It's just we assume everything is constant. However, our estimation could be a little bit optimistic or a little bit pessimistic. So we want to know if the number deviate from the number that we use by a certain percentage, what will be the consequence? The consequence for the overall profitability. For example, if we use net present worth to look at it, then we want to know if the value that we expect deviate, the true value deviate, for example, 15% from the value that we thought it will be, what kind of consequences it will resolve. Sometimes it may even bring a positive net present worth to minus present worth. Sometimes it's not very sensitive. Some values are more sensitive. Some values are not as sensitive. So for sensitive one, definitely we want to as accurately as possible. We want to estimate them as accurately as possible. For those less sensitive one, right, it changed by 50%, but the net present worth doesn't change too much, then I think those are okay. So we want to go through sensitivity analysis to see the impact of the accuracy of the estimation on certain variable. Or we can just say that we want to see the variability of certain variable, the impact of the variability of certain variable to the overall profit. Okay, that's the sensitivity analysis. Break-even analysis is to say that for a lot of projects, it's not one definitely better than the other. If our estimation is not correct, maybe originally with all the estimation that we have, and we find project A is better than project B. However, there was some mistakes in the estimation. The result may turn out to be B over A. And sometimes it depends on, for example, economy of scale, right? We know that without economy of scale, we may choose a certain way of conducting a project. But then with economy of scale, with the consideration of economy of scale, then we may turn into a different solution. So there's a so-called break-even point, right? The the value continue to change. Originally, maybe A is better than B, but after that break-even point, we choose B over A, right? Or as the number continue to increase, then there's a best solution. Until a certain point, clearly, the other solution becomes more sensible. Right? So that's a break-even analysis. Scenario analysis is something more. It's also quite useful, but it usually just divided into very few cases. For example, we have base case, then we have base case, usually most likely case. Then we have something called optimistic case, right? And there's a pessimistic case. And these cases together, we can see if the extreme cases, that is optimistic or pessimistic cases happened, then what will be the consequence, whether or not we can still deal with the situation. So optimistic and pessimistic basically serve as the boundary. And the most likely scenario is the base scenario. That is, this is probably the case that it will happen, but we are not sure. In the worst case, in the best case, we also want to find the consequences. Then we'll use these three references for making our decision. Okay, so that's scenario analysis. It's also very useful. I was involved in a very big project. In that project, I think this scenario analysis was the foundation of the detailed analysis. They need to know the worst case situation, the best case situation, and most likely situation, and then they work within or with the reference to these three situations and see what kind of room that they have for making changes, for generating more detailed design. Next. So again, we'll have these data, but then these data will not be explained in greater detail, but these data will be used for later so-called variability computation. Here there's an example, this example of transmission housing project. Right? Transmission is a system. Housing is just to enclose this transmission, this machine. So we have we want to develop this and we'll generate certain revenue by selling these housing. So the unit price that we will sell will be like this. Now we are not really dealing with inflation or anything else. Now we are just focusing on sensitivity analysis. So the computation here will be more straightforward. Okay, so we're unit price. We have demand. Okay, and of course, unit price times demand will be our revenue. And we have unit variable cost. And of course, unit variable cost multiplied by the demand will get our variable cost. And we also have fixed cost. And depreciation, well, it's it will be related to fixed costs, but fixed costs may vary. But anyway, with the fixed costs, well, it's related to the asset. Here we don't see the asset, but anyway, and you can see that this is still based on the kind of depreciation that we saw earlier. Okay, so again, we are not dealing with the detail. We are not too critical about how these numbers come up with. We just want to show that under these circumstances, still during the process of computing net income, we have revenue. We're going to subtracting expenses from revenue to get taxable income, and we have depreciation, and these are the costs. Variable cost, fixed cost is given. Variable cost is based on unit cost multiplied by the demand, and we get again taxable income for each of the 5 years. Then we can compute income tax 40% based on taxable income. So subtracting income tax from taxable income, we get net income. So we get net income for each of the 5 years. Okay, net incomes. Again, this is income statement. Next page. But what we want to have is net cash flow. So here in cash flow statement, we want to know have this net income. We will add depreciation back. You can see, right? Just like what we did before. And now we look at the investment. This investment will result in the depreciation that we saw in the previous page. Remember, we have operating activity, investment activity. We could have financing activity, but now we only have investment. Okay, so that we can compute net cash flow here. Okay, and these are like salvage value and gain tax from salvage value, and so on. So these numbers we have seen previously, the earlier example, when we consider depreciation and salvage value and so on. Okay, so here you can imagine that the computation seems to be straightforward, and you can also say that, oh, yeah, we consider all the necessary adjustment in the computation. However, the problem is a lot of things in the computation are not certain yet. For example, can we go back to the previous page? For example, unit price is 50. Is it going to be 50? We don't know. We haven't really sold the product. The price will be set only after probably we know the cost, then we will set the price. So the revenue will not be like this. So what if the sales unit price or the sales price will be different? And also demand, we estimate that it will be 2,000. Well, estimation based on past experiences. But then, is it for sure 20%? Or again, 2,000? Again, we are not sure. Right? So if these two numbers are not certain, and the revenue will not be fixed. Similarly, unit variable cost is based on estimation. We know that the product need to require certain process and certain material and certain labor, basically. And we are assuming that the machine can reach certain performance. So this is the variable cost that we find, but it may not be true. So this is also uncertain. And fixed costs could be uncertain too. We don't really know for every setup how much it's going to cost. Here we are assuming that it's 10,000. It could be more, it could be less. Next page. And here I think investment could be uncertain too. Investment meaning that the machine will cost a certain amount of money, and this can be a little bit uncertain too. Okay, so we have this amount of money. We have net cash flow. These are cash flow. we can compute its present worth or net present worth. We can see how much money that we'll make based on all the number that we have. However, this will be just a base that we still need to vary to see if there's any error in or discrepancy in estimation of the variable, and what would be the impact on the net present worth or the present worth. Okay, so here we can compute present worth. Next. So the present worth that we computed was in fact 40,169. Okay, if the estimation on unit price, demand, variable cost, fixed cost, oh, so machine price is known, but the salvage value is uncertain. Okay, if these are uncertain, yeah, for sure salvage value is not fixed, because if it turned out to be certain value, we need to make some adjustment, but it could be higher, it could be lower, it could be a lot higher, so it's uncertain. So if everything is as we expected, we'll get this value. However, if we want to vary the variable one by one, not one by one, individually, okay, so if we want to see the impact of variability on unit price, we can again go through this process. If the unit price is in fact 5% lower, 10% lower, 15% lower, 20% lower, or it could be 5% higher, 10%, 15, and 20% higher, what will be the net present worth, or yeah, NPV, net present value, right? So assuming that it's an original value, right? It's we can get this net present worth. If it's lower, 5% lower, 10%, 15%, when it's only 20% lower, then we could be losing money already. So the unit price is quite sensitive. On the if the estimation on the unit price is not very accurate, then the impact is quite big. Okay, that we can see. The demand, demand is 5% lower, 10%, all the way to 20%. It's significantly lower, but however, at least it will not be like the unit price estimation of the unit price, that the present worth is almost negative, right? And if you look at variable cost, the cost is lower, and of course the net present worth will be higher. Even if the cost is higher, 20% higher, I think it's still bearable, because the cost is a lot smaller portion comparing with the revenue, right? So it's still bearable. Fixed costs, higher or lower doesn't matter that much, right? Comparing with the net present worth of 40,169. Salvage value, which is a relatively big value, but however, comparing with the others, it still doesn't change that much. It's quite small. It's the sensitivity is even smaller than fixed costs. So basically, we are saying that we want to observe. We know that each of the value that we use were estimation, and if they have some discrepancy from the true situation, we want to know how sensitive they are to the error in estimation, and this number basically reflect that. And here we want to see is even stronger than how their variability is. We want to see whether or not it may turn the project from project that should be accepted to project that will be rejected. If the unit price, if we cannot estimate the unit price accurately, we do have that risk, and the unit price impact the overall profitability the most, as you can see. Next page. So we can plot the values, right? For each variable, we have minus 20 to plus 20, and the changes will be linear. So we can just plot, and here you see clearly the unit price, right? You can make more, and you can lose more. Here is still go back to my earlier statement that things that have higher profit, potentially higher profit, are usually associated with higher risk. You can probably make more, but if in the worst case, you will lose more than others. So we can see, I mean, from the numbers, we can see roughly, but it's not that clear. But here it sees very clearly that, yeah, unit price is very sensitive to the change, to the variability. Demand is also, but not as severe as unit price, right? And you can just look at these sensitivity, and for sure, as I said, fixed cost and salvage value are probably not much. So that you can, if you want to do the estimation, you want to make sure that it won't create a lot of impact, or the impact is bearable, then you want to estimate the value very accurately. Like unit price is too risky. Right? You have to make sure that whether or not it's the value that estimate. Otherwise, 20% more to 20% less can make a tons of the most significant impact. This is our sensitivity analysis. Next. So again, here we have this example. There are values here, and again, I won't go through all of them, but here is basically to say that we have some mutually exclusive alternative. And earlier I also mentioned that a lot of variables the value of those variables were assessed. If they have deviation, we may choose one over the other under two different circumstances. Here we have these four solutions. Okay, electrical power, LPG, liquefied. I'm not sure what this is. LPG, gasoline. Usually we have liquefied natural gas, LPG, and gasoline, diesel fuel. Okay, we have these four solutions. And with all the values that we have, we may come out one solution is better than others. Okay, because we do this pairwise comparison, and we can see which one gives us the highest net present worth that we can do. However, we are not sure that here one thing we are not sure is we assume that the shift per year is 260, but it could be higher, it could be lower. Okay, so we want to see if we want to increase or decrease the shift, then what will be the consequence of our decision on these mutually exclusive alternative? Again, these are they have different numbers. You can just see that these numbers are computed here. Like fuel consumption per shift is this per shift. Then unit consumption of the fuel, the cost is this. So you multiply this, you get this, and so on. So these are just computation, very simple computation, and these are the number that we'll be able to use. But basically, what we want to see is if the number of ships per year changes, what will be the result? Okay, what will be our decision? Next. So we can compute different costs. We want to, again, coming out with the net present worth, but we need to find out all these relevant data in their final form. So first we compute their ownership costs, and this equation is a simplification of the equation, so won't be able to explain it on the surface, but basically, let's just say we trust how they came out with this. So we have so-called capital costs, ownership costs, with 10% discount rate. Okay, we can compute for each alternative, and we get these four numbers. Okay, again, these computations still need to be done, but we won't go through them. And if you go back to the previous table, and if you follow through the computation, follow through what I said, you can still come up with these like ownership costs. Next. And you want to compute the so-called annual operating cost, right? A function of the number of shifts per year. As I said, we are curious about the shift. If the number of shifts changes, whether or not it will influence our decision and in what way. So we assume, although we saw previously is 260, but it could be larger, it could be smaller, and we'll see how that goes. And the annual operating cost, again, is based on, if you look back, you can see that there are two costs, variable costs, there's a fixed cost, add them together, and there's an ownership cost from the previous page, so you can add them together. Individually, you can compute them. Still from that table, you can compute that. The M represents the number of shift we assume, right? The more shift we have multiplied by the variable cost, it will be different. Next. And we can combine ownership cost. In fact, this total ownership cost, it was converted from the ownership cost to the annual cost. So you add these two together, right? Add the two the numbers from the previous two pages together to come up with this. So for electrical power, this is the annual cost. Okay, that is they took all the money and computed the total equivalent annual cost. Okay, it doesn't matter how many years that go, they just want to know. In annually, if you convert it to annual cost, how much cost it will be. However, there's an uncertain part, which is the number of shift that will be used, adopted every year. Okay, next. So those will be costs, right? So annual equivalent dollars. Now we plot those four lines, those four equations. Okay, and we'll see that these four lines. And here we are trying to get as smaller the annual equivalent cost as possible. So here we see clearly that if we are below a certain number, gasoline forklift give us the lowest annual equivalent cost. But when we have more shift, we use it more, then electric forklift truck is preferred. Right? This is why I said here we may only have one value, which will make the difference for making the decision on choosing which alternative, and it's it depends on in a lot of cases it can also be considered as a pivot point. So before that pivot point, we may choose one solution. In this case, when we don't work on the machine that often, I think gasoline is better. When we do it extensively, then we'll choose electric forklift. But somewhere in between, somewhere here, they have some intersection here, a lot of intersection here. Here it's probably indifferent. Anyone will be good. But before this point, one will be better. After this point, the other will be better. Here is a little bit confusing. This just small portion, but it's quite close, so probably it's still okay. But if the number is significantly smaller, then gasoline. If the number is bigger, 160. If you do 160, for sure you'll use electric, or 180. Yeah, 160 and beyond, for sure. But if you only have 80 shift and lower, 40 shift, 20 shift, then gasoline will be better. Okay, so this is about the sensitivity analysis. Previously saw some lines, and you observe the extreme cases to understand the risk and potential profit. Here you are trying to understand the pivoting point, and on two sides of the pivot, you may have different decision. In this case, it's about when we have 90 shift, around 90 shift, which is the pivot point. Before that, in fact, you can see precisely here, they have some numbers here. But before that, we use gasoline, one alternative. After that point, in terms of number of shifts, we'll choose a different solution. Okay, next. Okay, I think we probably ran out of time already. So we'll continue. I try to go slowly, as slowly as possible, because I feel that with remote learning or distance learning, it's, for basic subject is still quite difficult, and sometimes I need to write something on the blackboard and something. But in the semester has been quite in some sense difficult, but some challenging. So I hope that you guys can do the exercise, going through the material and trying to understand details, and join the lab, ask as many questions as possible. And for the exams, if it requires a lot of computation, it will not be in the exam. However, we will ask you to do the computation. Oh no, yeah, computation in your project. I think the TAs are trying to set up the requirement, and you need to come back to understand the content so that you can analyze the data appropriately. Okay, so again, need to be very careful during this period. Although I'm not sure how many of you have received information from the university. Although for the rest of the world, most of the countries have gone through something a lot worse. However, in Taiwan, we try to contain the virus as much as possible. Uh, uh, we want everybody to be safe, or we want the environment to be safe. So during the next 2 weeks, try not to engage contact with strangers, keep away from them, and try to eat on campus as much as possible, or even in your own room, so that you will lower the chance of being infected. It's quite critical. So all of us are doing this because we want to keep the infection contained. So we are basically sacrificing our learning because of that. We hope that will work. Okay, so yeah, so I will see you hopefully next week. I will do the presentation for the other class, and you will watch my recording. So next Monday, we won't have classes. You will watch the recording I will do. If we do have it, I have to check. But anyway, we'll continue in the future. Okay, take care. Okay, bye. You can log out now.